Hey there, I'm Jody Seibert, founder and owner of Fix Your Accounting. I'm here today to talk about some ways you can spot check your bookkeeping to know whether it's right. Whether you're doing the bookkeeping or paying someone to do it, or you're a bookkeeper yourself, how do you know if it's really correct? And oddly enough, most of the answers to that question can be found on your balance sheet. We'll start with the bank accounts. After you reconcile your bank accounts, and this includes checking, savings, and credit card, the balances should be pretty close to what the bank says online. And this can be a common trouble spot, that if you allow unreconciled items to pile up, it can contribute to this being very wrong. And that usually means that those unreconciled items are mistakes, likely duplicates, and need to be researched and corrected because, of course, that also impacts the income statement and ultimately has an effect on whether you're profitable, at least on paper, and what taxes you pay. So that's kind of how you would know on your bank account section. Accounts receivable is another one. As a business owner, you have a fair idea of what you're owed, and this should be reviewed. Your accounts receivable detail report should be reviewed. If this is unusually high, it can mean that deposits were booked as new sales rather than matched to an existing invoice, which can also distort your income. Again, on your income statement, a lot of this will roll over into your income statement. In the other assets, undeposited funds is kind of my hated favorite account. Undeposited funds is only meant to hold payments that haven't cleared the bank. Namely, you accepted check payments and haven't prepared the deposit and it hasn't cleared the bank. If you accept a bunch of checks, prepare the deposit, make the deposit in QuickBooks. If you're using QuickBooks payments, again, those payments should be clearing through here. If this number is unusually high, this needs a whole lot of work and research to figure out, did payments get duplicated or what happened there? Because again, this can impact your income and what you're paying taxes on. Your fixed assets, one of the notable things, now I'm just here in QuickBooks Online in the sample company, and it doesn't matter what accounting software you use. Pull up your balance sheet and try to follow along. Typically with fixed assets, I would expect to see an accumulated depreciation figure here. That likely, I personally would book that from the tax return based on what your tax accountant did. So that would be an item missing here. Down here in liabilities, accounts payable is the same way as accounts receivable. If this is unusually high, it could mean that transactions were recorded in the bank feed as new expenses and not matched to an invoice. It could also mean, it could mean not paying your bills, which is a bad thing, but it could mean that these are all duplicates. So this, again, you would run your accounts payable detail report, see what's there, and do some troubleshooting to get this number down to what you feel you really owe your vendors. Credit cards are like your bank accounts. This should pretty much match if you log into your bank. Should match that. If it's unusually high or low, again, that's a trouble spot. You should not really have to log into your bank to know what your bank balances are. You should be able to look at your books if this is done correctly. Again, if there are unreconciled items, this can unnaturally inflate this liability and even inflate your expenses on your income statement. These other current liabilities are the same way, assuming your loan payable should go down. If it's not going down and you know payments are happening, are they being incorrectly recorded as an expense? Same way with this payable. If it's not going down, it could also mean that the expense, it could be recorded as an expense on the income statement and actually doubling that item. This is another loan. The same way with the other loans, it's often that loan payments are made an expense to the income statement and in error. The other thing is you need to make sure on all loan payments that you're breaking out, the only part that should be reducing your loan accounts would be the principal, and interest should be an expense. Open balance equity is another dreaded account. It is supposed to be zero, but unfortunately becomes a dumping ground for unknown transactions. Can't figure out what else to do with them. If this is not zero, you need to drill into this and figure out what's going on. If two things you need to keep in mind, that if you make an account inactive, especially in QuickBooks Online, you decide there's an expense account you don't need to use anymore, you make it inactive, QuickBooks will clear every transaction out of the account and dump it in open balance equity. So don't do that. That's a bad thing. Or at least work with your accountant to come up with a better way if you're trying to reduce the amount of accounts that you're using. The other way money can accidentally end up here is if you are using the inventory function. QuickBooks will often, and like say you make an adjustment to your inventory, then QuickBooks will put that adjustment to open balance equity rather than an expense account. And other than that, there should be nothing else in here. Open balance equity was meant as an account to be used during setup and conversion of your books from QuickBooks Desktop into QuickBooks Online, or just setting up your books. And after that, this should be zero. And these are transactions in this account are a problem, and they also impact your income statement, which ultimately impacts your taxable income. So that's why these all need some attention. I hope you found that useful to kind of do a quick and dirty walkthrough of your balance sheet. If you need any help sorting out any questions that came out of this, please get in touch.